Welcome to Tax Insights, presented by Hawkins Ash CPAs.
Good morning, listeners. Welcome back to Tax Insight here on WOMT 1240 AM, 107.9 FM, and online streaming anytime, WMTradio.com. We're talking with Jeff from Hawkins Ash. Jeff, good morning, sir.
Good morning, Terry.
How are you?
Doing well.
What is today's topic, my friend?
So let's talk a little bit about business nexus, because I know last week we talked about how individuals needed to report income no matter where it's earned, worldwide. This week, though, I want to talk about the requirements that businesses have to report their income when they do business in multiple states. This is referred to as nexus. And, as we talked about before in the sales tax context, but today I want to talk about it in the income tax context.
So let's go back to the sales tax nexus, since I remember us talking about it. That had to do with a Supreme Court case, correct?
That's right. So that was back in 2018. It was the Wayfair case. And the U.S. Supreme Court ruled in that case that states could impose what they call economic nexus, which means that this nexus was based off of the volume of sales that went into a state. So it didn't matter if you had any other connections to that state, as long as you shipped a certain dollar amount, normally maybe around $100,000 or more, or you had a certain number of transactions in that state, and that's normally about 200, you would need to charge your customer sales tax if that item was taxable. Now, each state has their own different thresholds, but that sales tax nexus is only based off of sales just shipped in with no other connections.
So how is income tax nexus different then?
So in order to have income tax nexus in a state, you actually have to have a connection above and beyond just shipping something to that state. This is a higher threshold, and this was a result of a 1992 U.S. Supreme Court case, which was Quill.
So what is that higher threshold?
So here's what the U.S. Supreme Court said. They said that a business needed to have a physical location or a physical presence in a state. They needed to have employees in that state, or employees needed to make regular trips into that state. A company would have to have inventory into that state, or they'd have to deliver a product in that state in their own trucks in order to get that nexus to make that state be able to tax you on some of the income. So if a company has any of these, the case may be strong that they have nexus and have to file a tax return in that state.
So what happens then once a company actually has nexus?
Just basically have to file a tax return in that state and pay the taxes to that state.
Okay, so how do you know how much income is earned in that state?
Yeah, most states use sales as the determining factor, and that's called apportionment. So if they have, let's say, for example, 10% of their sales in another state, then they report 10% of their income to that state. And although most sales do use just this sales apportionment, others try and get fancier and more complicated by using payroll, inventory in that state, or assets in that state as different factors. Now, the nice thing is that for Wisconsin and Minnesota, sales is the only factor that they use.
All right, so just like we talked about last week, are there sales taxed in both states then?
In most cases, no. So like for an individual, there's a credit available in the home state to offset any taxes paid in the other state. Or for corporations, they only pay tax on their home state income, not the other state's income. So, there's not that many situations where you're going to pay double tax. Last week we talked about Florida. That
Right.
would be an example.
Right.
But overall, they pay generally the same amount of tax. It's just spread over multiple states.
Jeff, time is running up here, but last question for you in today's program. What if a company is not paying taxes to a state, but they should be? What happens then?
So states are doing a much better job of finding these companies that are doing work in their states. And normally a state has a 3 or 4 year statute of limitations, which means that they can't go after you after about 3 or 4 years. But if a company never files a return in that state, then that statute never runs. So a state can literally go back to the beginning of time and assess tax, interest, and penalties to that company. So it's a pretty big deal if you're doing a lot of business outside of your home state.
Yeah. Jeff, great information each and every week here in Tax Insight. How do listeners connect with Hawkins Ash?
I would go to our website, which is hawkinsash.cpa.
Yeah. Jeff, we'll talk to you next week here on WOMT.
This has been Tax Insights, presented by Hawkins Ash CPAs. Learn more online at hawkinsashcpas.com. Hawkins Ash CPAs. Part of your business, part of your life.